Okay, good morning, everyone, and welcome to our webinar. Glad to have you here with us today. I'm going to be talking about I suppose, the big difference between my future fund and a private pension. I'm also here with Angela Canavan. She is a business owner. Her business is Canavan Byrne, and she is a HR expert. She's been providing HR advice for over 25 years. So I'm going to first kick off my part. It'll be around 10 to 15 minutes, and then I'm going to pass over to Angela. So my business is Pure Finance. I set it up in 2017. I provide advice in relation to pensions, life insurance, and financial planning. Emma also works in Pure Finance, and she provides support, admin support for clients and customers. So the agenda today, firstly, I'm going to talk about the pension landscape in Ireland, the basic rules around My Future Fund or automatic enrolment. But the meat and potatoes of the presentation is really to compare from an employer perspective and employee perspective, is automatic enrolment better for you, or is a private pension better for your staff? So I'll look at tax relief for the state top-up, contribution levels and contribution restrictions, look at the fees, and also compare the fund choice available with automatic enrolment and how does that compare to a private pension, looking at the earliest drawdown stage when it comes to automatic enrolment and the drawdown options. So the pension landscape in Ireland, the average industrial wage in Ireland is 45,000. The state pension will be close to 16,000 next year, and there's currently 800,000 employees that don't have a pension. So the government are worried that a lot of people are going to drop off a cliff when it comes to, or when they reach retirement age. So their income is going to drop from 45,000 to 16,000 because they don't have a pension, or they don't have a private pension. The Irish population, the government are concerned about 800,000 employees not having a pension, but they're also concerned about the fact that in Ireland, we have an aging population. There's 4 workers to every retiree currently. By 2050, there'll be 2 workers for every retired person. So obviously the government is they're going to have a lot less tax money. So they're concerned about how are they going to be able to provide for 800,000 employees or 800,000 people in Ireland in 2050, because there's going to be a lot less tax revenue. So the 3 main reasons why they've set up automatic enrollment is our population is aging. There's question marks over the sustainability of the state pension. And the 3rd major reason is pensions aren't sexy. People don't like to set up a pension. So if you make it mandatory, people will have a pension. So those are the 3 main reasons why they've set up automatic enrollment. So the rules around automatic enrollment, you basically you will get automatically enrolled if you don't already have a pension scheme in place. So if you don't have a pension scheme going through payroll, where either the company's paying in from the company or you're paying in an employee contribution, you will be automatically enrolled. So the rules are you have to be between the age of 23 and 60 to opt in, and your salary has to be over 20,000 a year. You can opt out after 6 months as well. So if your salary is over 80, they're going to only use 80,000. Okay, so how does it work? So a lot of this stuff you probably already know, but it's just a quick recap. The employer will have to pay in 1.5%. The employee will have to match 1.5%, and the state will top up 0.5. That's going to obviously go up over the years, but that's the starting point. So 1.5% of salary. To set up automatic enrollment, you're going to need to register. It's really important that if you want to do the automatic enrollment scheme, you're going to have to register in December. So you must register with the My Future Fund portal in December. And then you're going to have to decide on the contribution, how you're going to pay the contributions. And then you're going to have to run payroll as well. You can obviously stop or suspend contributions after 6 months. So you can opt out of the scheme after 6 months, but you will automatically be enrolled after 2 years if you stop if you step out of the scheme. In relation to the big difference between the two, automatic enrollment. So one of the key differentiators between automatic enrollment and the private pension is, how does the tax relief work and how does it impact an employee? So if you looked at automatic enrollment, and the employer will have to pay 1.5% of salary, employee will have to pay 1.5% of salary, and the state will obviously have to top up. So that's 450 euros from the employer, 450 euros from the employee, and the state are topping up. That is a big difference between a private pension. You don't get the state top up within a private pension. It's tax relief. So if we look at this example, Chris is earning 30,000 a year. With automatic enrollment, he's getting 1,050 into his pension, into the My Future Fund. Whereas in a private pension, the employer is paying in 450. But if you look at the employee contribution, this is a key differentiator between automatic enrollment and a private pension. When you pay into a pension from a private pension, you're paying it off your gross pay. So you're actually getting tax relief. So the 450, it's not costing the employee 450, it's costing him 360. However, if you look at the bottom line, automatic enrollment, he's getting 1,050 going into his pension, whereas a private pension, he's only getting 900. He's not getting the state top up. But if you look at the tax relief compared to the top up, there's a difference of the state top up is probably giving him a benefit of 25%, whereas with tax relief, it's getting him 20%. So my recommendation for people earning at the lower rate of tax, they're much better off setting up through the auto-enrollment scheme because they're getting better tax benefits, basically. They're getting a top up and they're getting more going into the pension scheme. Now, if Chris is earning 50,000, that changes the picture. As we look on the left side of the screen, if the employer is paying in 1.5%, that's 750 euros a year. The employee will have to match that with 750, and the state will top up a contribution. So that's 250. So once again, a private pension, you're not going to get the state top up. However, the employee contribution is the big differentiator. So if we're paying in to a private pension and you're at the higher rate of tax, it's not costing you 750. You're getting 40% relief. So it's actually costing Chris 450 euro compared to the 750, which is a huge difference. So it's going to cost him less to set up a private pension. He's not going to get the state top up. So if we compare it, he's actually getting more in auto-enrollment. So 1,750 into automatic enrollment and only 1,500 into the private pension. But it's costing him a lot less. But if we were to take a comparison where it's costing him 750 in a private pension and 750 in automatic enrollment, if we gross up the 750, he would be paying in 1,250. And that extra 500 is the tax relief. He's getting 2,000 euro into a private pension, whereas automatic enrollment, only 1,500. So for higher income earners, it makes a lot more sense to pay into a private pension. Okay, those two slides were the most difficult slides. These other slides are a lot easier to I guess, take in. The big difference between automatic enrollment and a private pension when it comes to fund choice, automatic enrollment is only giving you 3 fund managers. They're Irish Life, Amundi, and BlackRock, and then they have a default fund. With a private pension, you have choice. You can choose from hundreds of funds. So you have a lot more choice when it comes to investing your money. Another important point when it comes to investing your money, no one's giving advice with automatic enrollment. So if the stock market crashes, what do people do? With a private pension, you have reassurance from a financial advisor, which makes a big difference. Okay, the fees. The fees are going to be a lot lower with automatic enrollment. There's a problem with the fees, though. They haven't been completely crystal clear on how much they're going to charge. They've said it's going to be close to 0.5%, and then there's going to be an admin cost. So they have scale with automatic enrollment, so the fees will be a lot lower than a private pension. With a private pension, you generally have money taken off the top. That's called the allocation rate. But if you could have a competitive offering where you're getting 100% into your pension, so no charge off the top, and then there's a management fee. Another key difference between automatic enrollment and a private pension is with automatic enrollment, you're restricted. You can only pay in 1.5% employer contribution, 1.5% employee contribution, and the state tops up. With a private pension, you are not restricted. So if we take Chris as an example, he was earning 50,000. If he was a director of his own business, he could pay in 100% of his salary. So he could put in 50 grand. That doesn't happen very often, obviously. But you have a lot more scope to pay in more than 1.5% in a private pension. And your employees, they could put in a percentage of their salary depending on their age. So if someone's, let's say 40, they can put in 25% of their salary. That's the maximum level. So obviously there's a lot more, it's less restrictive within a private pension. Another key point is the earliest you can retire from a pension scheme within auto-enrollment is 66. With a private pension, you can retire from 50. So if I set up a business and I sell that business, I can retire from that pension scheme within that business from the age of 50. So that gives you a lot more flexibility. Another key point when it comes to pensions is, okay, what happens when I retire? With automatic enrollment, you can only take 25% of the fund tax-free, and the balance is subject to income tax. Now they say they're going to change this and make it more attractive. However, this is currently how it stands. With a private pension, you could get 25% tax-free, and you have three choices when it comes to your balance. You can take that loan, get taxed income tax, you can purchase an annuity, or you could invest in an ARF. So an ARF allows you to grow the money tax-free from a growth perspective. So in conclusion, my own view, and this is key, my own view, automatic enrollment or my future fund makes a lot of sense for people on the lower rate of tax. It also makes a lot of sense for people that have no interest in pensions. So they only want to pay in the 1.5%. The employer would pay in 1.5%. So it's just like a matter of ticking the box and they're sorted. If your staff believe in pensions, they want to pay more into pensions, and generally their tax rate is at the higher rate of tax, they want support, I think private pensions make a lot more sense. So that's my side done. So what I'll do is I will hand you over to Angela and I'll stop sharing my screen. So thanks for listening.
Can everybody see that there now? Yeah, can you see it, Owen?
See it perfectly, Angela, yeah?
Okay, perfect. I'll start off now. So I suppose from my point of view, what I'm doing here is looking at some of the practical, I suppose, step-by-steps to get to January, and particularly from an employer-employee perspective, and from, I suppose, wearing my HR hat. And I suppose the importance of following particular steps, particularly in the next number of months, because in fact now we're in November, so we're getting to, like, November is the critical time to decide on what you're doing as an employer, and then following the steps up until January. So if you look at some of the key dates there, one important point to make is that how does this new agency decide on who is eligible from a pay perspective, because you have to be earning over the 20,000 a year. And what they do is they are taking a 13-week look. So whatever way your employees have been paid, averaged out between September and November 2025, that's what it will be based on. Now, that already comes with issues, because seasonal workers, people who've been off for the summer, for example, working on term time, or been off for the summer and then coming back in September, it probably will give an inflated amount of pay, because they're just taking in that window. So the window we're looking at is September to November 2025. So we're now nearly midway through November. So at the end of this month, that's the look back period that that NARSA, the new agency, will be looking at. In December 2025, there will be an employer portal launch. So NARSA, the new agency, will have a portal, and that portal will be available to both the employer and the employee, to so that it's linked, of course, to revenue, because they will be getting the information from revenue. That revenue information then will be put up onto the portal, the NARSA portal, and there's total transparency in that both the employee and the employer will have access to that. What you can expect then is in December, next month, you will get your payroll notifications based on this 13-week period. So you will get the notification as to who is going to be, if it's auto-enrolment, who is going to be auto-enrolled, and what the payments will be, and what your contribution will be, what the employee's contribution will be, and that'll all come in December. And of course, as Eoin says, if it's all to do with payroll, so if somebody has a pension that's going through the payroll, they are automatically excluded from auto-enrolment. So they won't be enrolled on the portal. And another important point to make is, because it's a question that comes up all the time, that if an employee has a private pension, they're not paying it through payroll, well, NARSA won't see that, so they will be automatically enrolled. So that's just a question that comes up all the time. So it's only what goes through the payroll, and it's only what goes through the payroll that NARSA will have eyes on, and that will decide on who is auto-enrolled or not. And then, of course, in January, everything goes live. And I think it's important to say as well, you're here this morning, which is fantastic, getting some information about auto-enrolment and the differences between auto-enrolment and PRSA or private pensions. But the information is changing all the time. So obviously this is a completely new organisation. It's a new process. So every day I look at the official information, there are extra pieces of information in there. So I think it's really important as an employer to keep your eye on what's happening, and to be aware and to pick up on some of the new information that's coming down the line. So the payroll notification then, NARSA will use revenue payroll data to identify employees. The automatic enrolment payment notifications will be issued to employers in early December. There is the initial 13-week look back period. And if you're using, so if there is a PRSA being put in place or a pension, really you need to have that set up and done by the end of this month if it's going to be considered for January. So I think that's an important. So dates at this stage, time is running out. A lot of people are really only waking up to what's happening now. So I expect people like Eoin will be extremely busy in the next few weeks. So I suppose then payroll system engagement. So there'll be ongoing engagement between NARSA, payroll software providers and revenue. So I suppose one of the things as well, most of the payroll software is being updated to cope with this. I think it's important that if you're using a particular software, or if you're using an accountant, that you start to link in with them in relation to asking the questions around compliance with auto-enrolment, and that they have the systems set up to do that. Employers should liaise with payroll providers and confirm compatibility, and obviously ensure everything is ready to go in January 2026. Okay, so as an employer then, with your staff, and I suppose I've gone through this process actually, and I've gone through the process with with my own team. So first of all, to identify who the eligible employees are, um, based on their age, earnings, and existing pensions, creating a list of eligible staff, and preparing to update contracts and communication, because obviously this is a new entitlement. It's a new employment entitlement, so it does need to I think I'm sitting on something. You do need to make sure that you're building this change into contracts of employment, and most importantly, that you're communicating with your staff. And in fact, that is a rule of the auto-enrolment system, is that you are providing accurate and up-to-date information about what is happening to your staff team. So what do you actually have to do? Amend your contracts with pension details and opt-out information if it's auto-enrolment or if you're introducing a private pension scheme. So for example, this morning I was talking with one of my own team, and we're now starting to issue addendums to our staff team in relation to I've actually, they're all going for PRSA on my team. So we're issuing those amendments to their contracts now. Update contracts for staff joining after January 2023, and review leave policies for contributions, because again, if you have staff who are on term time, for example, and they finish up for the summer and come back in September, obviously the auto-enrolment is suspended for that period of time. So again, it's giving this kind of information to your employees so that they understand it. A lot of employees at the moment are a little bit shocked in terms of the fact that they have to actually make a contribution, particularly for low paid workers. So low paid workers who are fairly tight on their wages. Now there's an extra contribution for them. So again, as an employer, you have a duty of care. You have a duty to ensure that your employees know and understand what this means for them and how it will impact basically on their pay packet as well. So information is key, communication is key, making sure that employees understand exactly. And one of the things, for example, that we have done is we've put together a questions and answers little guide for employees, which is written in fairly accessible language in terms of what this means for them. So that's again really important in the next number of weeks. So in terms of your contract, if you already, well, you should already have people on contracts of employment. There's no need to issue a new contract of employment, but what you do need to do is issue an addendum to that contract outlining what the pension arrangement is. So whether it's a PRSA or a occupational pension or auto-enrolment, there needs to be an update to the contract of employment. That it's really important as well, because under the predictable working arrangements regulations, you always have to make sure that the employee knows exactly what they're being paid and what deductions are coming out of their wages. So that needs to be included in the addendum. So what the employee contribution is, what the employer contribution is, and as the government calls it, the cherry on top, what they're going to pay in as well. So that's your addendums to your contracts. Everybody, of course, has to have a contract anyway. The contract should always be updated according to new legislation and employment law, and this is no different. Your handbook then as well, you should, employers should have now a policy in relation to pensions and automatic enrolment. And then finally, the other, I suppose, piece of information that needs to be updated now, under a contract of employment, you should always have a privacy statement. So a privacy statement, and regardless of auto enrollment and what's happening now, a privacy statement is where you tell your employees what data you hold about them and where it is shared. And of course, now their data is you would have had in that privacy statement that data is shared with authorities like revenue, and now we have another agency where their data is being shared. So just from a GDPR, a data protection perspective, it's a duty on an employer to inform their employee where data is shared. So we're now in November, and some of the key things you have to think about, obviously, is to choose between occupational pensions and auto enrolment, and Eoin gave a really comprehensive overview of the differences there. Compare options with a financial advisor like Eoin, and factor in budget, admin requirements, and I think Eoin told you as well, there's probably more admin associated with setting up an occupational pension or a PRSA than there is with automatic enrolment due to scale. It's also important in terms of yourself as an employer is factoring in and budgeting for this, because obviously this is an extra payment that all employers now have to make if they're not already making it from January 2026. So, and also, as I said before, making sure that staff are aware of the implications for them and their pay packet and how that's going to look. So prepare staff, and communication, as I say, is really important. Create staff communication. What I would do is like what I did. I met everybody on a one-to-one basis. I gave them the option of independent, confidential financial advice, and we got all that going. And we had a chat about it, and then people could. What I did in my company now was easier. I don't have a huge number of staff, but we gave people a choice actually in relation to it. Draft clear messages and contributions, benefits, and opt-out. Ensure payroll systems can handle it. Test payroll processes for accuracy. If you're a big company with managers or people working in a payroll department, make sure that they're fully trained and understand, and also that they can answer any questions that an employee may have. Set up systems and track enrolment status, and prepare frequently asked questions for staff. If there's anybody on the call today that would like a copy, we have those frequently asked questions done. They're actually questions that have come up to us as HR providers over the last number of months. So I'd be very happy to share those with anybody on the call, so that you would have them, and you can answer employees accurately. What you must not do is change any other contractual term that disadvantages the employee. So, if somebody, say for example, an employer was already contributing 6% through a PRSA, and this question has been asked of me, can I now go to auto enrolment because it's less at the moment? So the answer is no, because that would be a contractual change to the contract of employment, and any contractual change to a contract of employment must be negotiated with the employee. Must not introduce compulsory contributions outside AI unless already in a contract, right? So what that means is that if you set up a PRSA, right, as I have done in my company, I've set up the PRSA, I'm obliged to, instead of auto enrolment, I'm making my contribution as an employer, but you cannot force an employee to make contributions. They can have a choice in what contributions they can make. And I suppose as well, it is not to create two-tier employment conditions. So just be careful, whatever way you are rolling this out, that you're not creating or disadvantaging or providing unequal employment conditions within your company. And that's an important one as well. Okay, so I think this I've more or less covered that. Employer responsibility, right? So just to finish up, then, ensure no disadvantage, issue contract addendums and update staff handbooks, communicate clearly now to December 2025. Um, and this is an important one as well, is if you are going for auto enrollment, avoid influencing opt-out decisions. So with auto enrolment, an employee can opt out after 6 months, and then during months 7 and 8 can get a refund of their contributions. The employer contributions and the government contribution stays there and is still invested. But again, some employers may feel, oh, it's better if you opt out, because if they opt out, they they then at that stage don't have to pay the contribution. Okay, the contributions that they've already put in stay in the fund and stay in the pot. So so again, it's very important from an employment law perspective that you don't try and influence your staff to opt out. So you have to pay. You don't have to pay, basically. You have a responsibility to maintain accurate payroll returns as always. And the other thing then is making sure that, I mean, this applies to everybody, and anybody, once they reach those once there's those initial criteria, which is around age and the amount that people are paid, and also then if they don't have a pension. But everybody else, casual workers, part-time workers, multi-role workers, they're all included in auto enrolment if they reach those three critical criteria that Owen had spoken to at the beginning. Okay, so that's kind of very much a whistle stop, I suppose, through employer responsibilities around all of this. And I'm sure both Owen and myself, I'm sure, Owen, you would take questions as well now, if anybody does have questions.